4,600 tons of silver. That is the volume of silver India imported in the first 90 days of this year. Not in a full year, in 90 days. A single quarter, from a single country. To put that in context for you, total global silver mine production for an entire year is approximately 25,500 tons. India, one country, imported 4,600 tons in 3 months. That is 18% of annual global mine production absorbed by a single nation in a single quarter. And here's the part that should stop you cold. That 4,600 ton number is not the record. It is 173% above the same quarter last year. India's silver import pace is not just large. It is accelerating at a rate that the global supply chain was not built to accommodate. Most Western precious metals commentary covers the COMEX, covers the paper market, covers gold-silver ratio and technical levels. Almost none of it covers what India is doing to the physical silver supply picture, and what India is doing is more important for the silver price over the next 12 months than anything happening on the COMEX floor. Today I'm going to show you the full India silver import picture, what is driving it, what the supply chain math looks like when India's import pace continues at this trajectory, what gold is signaling about the monetary environment that is making India's silver demand explode, and what this means for your positioning in both metals right now. This is the story that changes the silver supply narrative permanently. Let's go. Let me give you the complete import data because the numbers build a picture that is more dramatic than the headline figure alone suggests. India's silver imports in Q1 of this year were 4,600 metric tons, 147.9 million troy ounces. The comparable quarter last year was 1,681 metric tons, 54.1 million troy ounces. The year-over-year increase is 173.7%, not 17%, not 73%, 173%. The primary driver of India's silver demand is a combination of two forces that most Western analysis treats separately, but that are in fact deeply intertwined. The first driver is investment demand. Indians buying silver coins, bars, and jewelry as a store of value. The second driver is industrial demand. India's rapidly growing solar manufacturing and electronics sector, which has been aggressively building domestic silver-consuming production capacity under government industrial policy initiatives. Both drivers are growing simultaneously and feeding each other. The investment demand is being driven by two dynamics. Gold prices in India have risen dramatically. Gold at $4,726 internationally translates to prices that have moved beyond the reach of many Indian retail buyers who have historically allocated a specific percentage of household savings to precious metals. Silver, as the more accessible monetary metal, is capturing the demand that gold's price appreciation has partially priced out of the Indian retail market. When gold becomes expensive in a country with a deep precious metal savings culture, silver absorbs the overflow demand. That absorption is happening at scale in 2026. The industrial demand driver is the Indian government's production-linked incentive scheme, which is subsidizing domestic solar panel manufacturing at a scale that has not been attempted before in India's industrial history. India's solar installation targets, 500 gigawatts of solar capacity by 2030, require domestic panel manufacturing at a scale that is creating massive forward silver procurement demand from Indian manufacturers who are building the factories to meet those targets. The combination of investment demand overflow from gold and industrial demand from the PLI scheme manufacturing build-out is what is producing the 173% import increase. Both drivers are structural. They do not reverse when the quarterly data gets attention. The gold price gap between gold and Indian household buyers' ability to purchase will not close quickly. The PLI manufacturing build-out is a multi-year program locked in by government commitment. The 4,600-ton quarterly rate is not a one-time spike. It is the beginning of a sustained structural demand shift. Let me run the supply chain arithmetic because this is where the India import story becomes most serious for the global silver market. Global silver mine production is approximately 25,500 metric tons per year, approximately 820 million troy ounces. Annual production divided by 4 gives a quarterly production rate of approximately 6,375 metric tons. India imported 4,600 metric tons in a single quarter. That represents 72.1% of 1 quarter's worth of global mine production absorbed by a single country. The remaining 1,775 metric tons of quarterly mine production must supply every other country's industrial demand, every other country's investment demand, COMEX delivery obligations, SLV ETF inflows, central bank and institutional accumulation, and the approximately 400 million ounces of annual global silver consumption from non-Indian sources. There is not enough mine production in a single quarter to supply India at its current import pace and simultaneously supply the rest of the world at historical consumption rates. The math requires either India's import pace slows significantly, the rest of the world's silver consumption decreases, recycling supply increases materially, existing inventory is drawn down, or the price rises to ration demand. The first three options are not happening at scale. India's structural demand drivers, which I just described, are not temporary. Global industrial consumption from non-Indian sources is not declining. Solar, EV, and defense electronics demand is growing globally. Recycling supply is already near its peak at current price levels. What that leaves is the fourth and fifth options: inventory drawdown and price appreciation. Both are happening simultaneously. COMEX registered silver inventories are declining. Shanghai physical premiums are elevated. The price has moved from $22 to the current $77 over the past 2 years. The price mechanism is already working. But the India demand acceleration I just described has not yet been fully priced into the market, because the 4,600-ton quarterly figure was only recently disclosed and has not yet made its way into mainstream Western silver analysis. When Western market participants fully process the India demand math, the supply chain arithmetic I just showed you is going to change the consensus view of silver's price trajectory in a way that is abrupt and significant. Let me now connect gold to the India silver story, because the gold market is providing independent confirmation of the demand dynamic that is producing India's silver import surge. Gold's price appreciation from $2,000 2 years ago to the current $4,726 is both a cause and a confirmation signal for the India silver demand story. Here is how the causation works. As gold prices rise globally, Indian retail buyers, who have one of the deepest precious metal savings cultures in the world, face a choice. They can continue buying gold at the higher price, which requires allocating a larger share of household savings to maintain the same ounce accumulation rate. Or they can shift part of their precious metals savings allocation towards silver, which provides similar monetary protection properties at a much lower per ounce price. At gold prices above $4,000, the shift towards silver in the Indian retail market is documented and significant. The gold to silver price ratio in India mirrors the global ratio, approximately 61:1, which means that for every ounce of gold an Indian buyer could afford at previous prices, they can now buy 61 ounces of silver. The cultural and financial motivation to shift towards silver when gold becomes expensive is deeply embedded in Indian precious metals purchasing behavior. Gold's price appreciation is therefore directly generating India's silver investment demand surge. The higher gold goes, the more attractive silver becomes as an accessible monetary metal in the Indian market. And the more India's industrial policy drives silver-consuming manufacturing, the more the industrial demand compounds on top of the investment demand. Gold at $4,726 is generating silver demand in India that gold at $2,000 did not produce. Every dollar of additional gold appreciation adds incremental pressure to India's silver import demand, as more of the retail savings flow that would have gone to gold at lower prices redirects towards silver. The gold-silver relationship in the context of India is not just a ratio compression story. It is a direct demand transmission mechanism. Gold appreciation causes silver demand surge in the world's most silver-hungry consumer nation. Let me now add the China dimension, because the combination of China's silver demand and India's silver demand creates a bilateral physical buying dynamic that the Western paper market has no mechanism to absorb at current prices. China is simultaneously the world's largest silver producer, accounting for approximately 14% of global mine supply, and one of the world's largest silver consumers. China's domestic silver production is increasingly being consumed by China's own industrial demand, particularly from its massive solar panel manufacturing sector, which produces approximately 80% of the world's solar panels and consumes silver at a scale that is not fully reflected in export supply figures. Effectively, China is retaining more of its own silver production domestically, rather than exporting it to global markets. The silver that previously flowed from Chinese refineries into the global supply chain is being diverted to Chinese domestic solar manufacturers. At the same time, China's Shanghai Futures Exchange physical silver market is pricing silver at a $10 to $12 premium above COMEX. Chinese industrial buyers are paying $90 per ounce for physical silver, while the COMEX paper price shows $78 to $79. The premium is the market's signal that Chinese domestic physical demand exceeds available supply at the COMEX paper price. Now combine China retaining more of its own production domestically, China paying $10 to $12 above COMEX for physical silver, and India importing 4,600 metric tons in a single quarter at 173% above prior year pace. Two of the world's most populous nations, accounting together for approximately 2.8 billion people, are simultaneously creating extraordinary physical silver demand. China's demand is showing up as a persistent $10 to $12 physical premium. India's demand is showing up as a 173% import surge that is consuming 72% of global quarterly mine production. The Western paper market, which sets the reference price for global silver through the COMEX futures price, is pricing silver based on positioning by Western institutional participants who are managing short-term paper exposures. Those participants are not yet pricing the bilateral China-India physical demand reality into their positions. The paper price is a lagging indicator of a physical reality that is already dramatically tighter than the futures price reflects. When the bilateral demand reality reaches Western institutional awareness, through silver supply chain disclosures by industrial manufacturers, through further quarterly import data releases from India, through continued Shanghai premium reporting, the repricing of the paper price toward the physical market's reality is not a gradual process. It is a step function adjustment. Markets do not gradually discover information. They discover it at once and price it in rapidly. Let me make this actionable, because the India-China bilateral demand picture has specific and clear implications for how you should be positioned in both gold and silver. For silver, the India import data, 4,600 metric tons in 90 days at 173% above prior year, is the most significant supply-demand data point released in the silver market in 2026. It is not yet fully reflected in the paper price. The window between when this data exists and when it is fully priced is the positioning window. You are in that window right now. Physical silver is the most direct expression of the bilateral demand thesis. When you buy physical silver, you are competing with Indian and Chinese physical buyers for a supply that is demonstrably insufficient to meet all three demand streams simultaneously at current prices. You are on the right side of the physical paper gap. You are in the same position as the entity paying $90 for physical silver in Shanghai, while the COMEX price is $78. You are holding an asset that the physical market values significantly above the paper reference price. For silver mining equities in India-exposed markets, Indian companies that produce or refine silver are experiencing demand conditions that have not existed in their operating history. While most investable silver mining equities are listed on North American or Australian exchanges, the companies with royalty or streaming exposure to Indian silver refining capacity are positioned to benefit both from higher silver prices and from India's extraordinary throughput demand. Quality streaming companies, which receive physical silver from miners at fixed costs in exchange for upfront capital, are capturing the bilateral demand surge through their physical silver entitlements. For gold, the India connection is equally relevant. Gold's price appreciation is generating the silver demand overflow I described, but gold itself remains in strong demand in India. Indian households continue to buy gold despite higher prices, just at lower ounce volumes. The cultural permanence of gold buying in India means that gold demand there is inelastic in the long term, even as the mix shifts toward more silver. Central bank gold buying in India, the Reserve Bank of India has been adding to its gold reserves consistently, is also a structural demand floor under gold that is independent of retail price sensitivity. The bilateral demand thesis, India and China both simultaneously creating extraordinary physical demand for silver, with gold's price appreciation generating overflow demand, is a structural story that does not resolve quickly. The supply chain cannot replenish fast enough. Mine production cannot respond in under 5 years. The physical market's pricing reality, currently visible in the Shanghai premium and the Indian import data, is going to pull the paper price higher as the data becomes impossible for Western institutional participants to ignore. The positioning window is now, in the gap between when the data exists and when it is fully priced. The summary: India imported 4,600 metric tons of silver in Q1 alone, 173% above the same quarter last year, representing 72% of one quarter's worth of global mine production absorbed by a single country. The drivers are structural. Gold price overflow from Indian retail buyers unable to afford gold at $4,726, and the government's production-linked incentive scheme generating massive industrial silver procurement demand from domestic solar manufacturing. The supply chain arithmetic: 4,600 metric tons from India plus the rest of the world's silver demand is not supportable at current mine production rates without either inventory drawdown or price appreciation. Both are already occurring. Gold's role. Gold appreciation at $4,726 is directly generating India's silver investment demand by making gold inaccessible to retail Indian buyers who redirect savings into silver. Every dollar of gold appreciation adds incremental India silver demand pressure. China adds the bilateral dimension. China retaining more production domestically, paying $10 to $12 Shanghai physical premium, combined with India's 173% import surge, creates a physical demand wall that the Western paper price has not yet fully reflected. Positioning. Physical silver for direct bilateral demand exposure, quality streaming companies for physical silver entitlement leverage, physical gold for India's continued monetary demand floor. The window is between when this data exists and when it is priced. That window is now. Subscribe. India's next quarterly import figure is going to be one of the most important data releases for the silver market in 2026. This channel will cover it the moment it is released. Comment below. Did you know India imported 4,600 metric tons of silver in a single quarter? Tell me what that number changes about your positioning.